So now we're in the segment of the show that we call the short and sweet. This is the piece that we post on YouTube, and you might already be watching it on YouTube, but it's the short and sweet summary of all the issues we've been discussing in the programme. So the main message we wanted to get over from all this was that if you've been laid off, if you're self-isolating, or you're actually suffering from COVID-19, there is help out there. I appreciate it's not ideal. There are all sorts of holes, people fall through the cracks, but increasingly those cracks are being covered in some way, shape or form. There are also organisations out there that are very keen to help you. I mean, there's resources of course are being stretched, but there are charities like Stepwise, there are charities like Turn to Us, both of which are consumer debt charities, but in the current crisis they're also keeping everybody abreast of the coronavirus help that's out there, the packages that are out there, and you can also contact them. You can phone them, you could contact them in web chat, webcam, all manner of stuff. There's also other organisations. There's one called Company Debt, a very good article about those in the local Bishop Stortford Independent only this week, underlining the aid that's available to companies. There's been further measures virtually every day, so this is another reason why it's difficult to keep on top of it all. Say for example, just after we recorded the last show, we had news that the government was planning to cover 80% of the earnings of workers under the PAYE scheme, and of course you think PAYE scheme, well, that doesn't really help the self-employed, but down the track, sure enough, there was help for the self-employed as well. So basically, in terms of being self-employed, if you filed a 2018-2019 tax return and you have a profit below £50,000, you'll be entitled to a grant of up to £2,500 a month. Bizarrely, it will be taxable, but it will go straight to your account. And in fact, as the regulations are suggesting, you won't actually have to do anything to claim that will arrive automatically. Whether it actually will or not is another matter, but if you file the tax return, HMRC will contact you in June and let you know that money will be coming to you. Obviously, June is 3 months away, and if you're not sure you're eligible for that, you need to sort of speak to people, and this is where the support comes in to give you the peace of mind. It's one thing thinking that you're going to be entitled to the money, but if you suddenly get to that date and there's no money forthcoming, you're in a world of pain having got to that point. There are also things like business interruption loans as well. Unfortunately, some banks have been better than others at signing their customers up to these sort of products, and other people and small businesses report having applied for these products and been turned down, which kind of wasn't supposed to happen. So there are clearly teething issues here, but you can see with each day more and more measures are being announced to help businesses. And only on Thursday this week we had a consultation paper published by the regulators, the bank regulators, and the consultation period ends basically in a few days' time. So this will be law next week. So it shows you how quickly these things are happening. And obviously people who are on PAYE and permanent employees are much easier to help and get to than the self-employed or the casually employed and stuff like that. So there will be people falling through the gaps, but progressively they're trying to get to everybody in that sense. The other aspect of assistance has been more to the general economy, though. This is where the Bank of England comes in, and people say, well, what has the Bank of England ever done for us? It's a bit like the Life of Brian, them saying, oh, what have the Romans ever done for us? Well, actually the Bank of England has done quite a bit for us. Some of it, though, is a double-edged sword. So for example, the most obvious thing they've done is cut interest rates. They've cut their base rate. Coming into this whole COVID thing, it was 0.75%, which is hardly high by historical standards when you realise their base rate was as high as 17% in 1980, and again in 1990 it got up to 15%. So, the youth of today, they know nothing about mortgage interest paying. No, that's not fair. That's a bit harsh, but you see what I mean. They were low by historic standards anyway, but they've lowered them from 0.75% to 0.1%. So if you've got a £200,000 mortgage, that means you're saving about £1,300 a month. Sorry, £1,300 a year. Sorry, I don't want to get anybody's hopes up there. That's about £108 a month. But you think of it the other way around. If you're a saver, what's 0.1% interest going to do for you? If you were in a savings account that was paying the base rate, and I appreciate some pay more than that, but if it was paying the base rate, to earn £10,000 in a year in interest, you would need a lump sum of £10 million. And I'm sure if you had £10 million in the bank, A, you'd want to spend a bit more than £10,000 a year, and B, not very many of us have got £10 million in the bank at all. So you can see the problems it causes, added to which, to preserve capital and to allow banks to lend as much as possible, the regulators have also said that the big banks can't pay dividends. And of course, the big bank dividends were an essential part of equity income plans for people already in retirement or thinking about retiring. So you might have been able to get a nice 4 or 5% dividend yield from your fund that was paid direct into your account every quarter or every month, depending on the plan. Those dividends are going to stop. And in all likelihood, by the time you get back to dividends being resumed, they won't be nearly so generous because profits will be down anyway. And to be fair, a lot of these dividends were unsustainably high and companies have been locked into sort of, we must maintain our dividend sort of thing. The other thing about it is that we talked about quantitative easing in the programme as well. Quantitative easing is one of these just annoying acronyms, QE and what have you. But what quantitative easing effectively is an attempt to drive down long-term interest rates. So the central bank, in our case the Bank of England, buys government bonds. It pushes up the price by buying lots of them, which pushes down the return and hence lowers interest rates. I mean, just, it's a bit of a sort of a concept to get your mind around, but when prices go up, yields go down, and that means sort of return to pensioners who are trying to live on these returns. It becomes very difficult for them to achieve any sort of income at all. But the magic, the magic source, which is not what they talk about too much about quantitative easing, is that the government is issuing lots and lots of debt to pay for all these generous measures, to get us through the corona crisis, and the Bank of England is buying all this debt. I mean, it's not a perfect one-to-one match, but it's as near as makes no difference happening. What happens when we get out of this crisis and people realise that, well, everybody wants to spend more money on the NHS, and my God, they deserved it, and it's under-resourced and under-invested and all the rest of it. What's there to stop us using this magical money tree to produce more money to invest in the NHS? And that's fair enough to an extent, because the government is issuing the debt, the Bank of England's buying it, so taxes don't have to go up. So, because that would normally act as a brake on the economy. If taxes go up, it would sort of undermine the effect of actually investing more in an economy. But if you could genuinely say, right, investing money in the NHS, investing money in education are genuine investments in the economy, well, there you go. But then, of course, you'll get people saying, we want pay increases and we want this, that and the other, and we want to spend it on discretionary stuff that isn't really an investment. Then you get inflation rising quite quickly, and it's much more morally difficult for the government to say no when everybody knows it's got this secret money tree there. So that's a problem for another day, because that's a problem for when we get out of this mess. At the moment, we just can't spend enough money because we need to protect the economy, need to protect jobs, we need to protect businesses so that they're still around to recover after the crisis. So that's us for another show. We really hope you found this useful, and if you have, please spread the word. Support us on YouTube, support us on Spotify, Podomatic. all sorts of channels. We'll be posting clips, we'll be posting podcasts and what have you. Reach out to us, Stuart at pensionman.co.uk. We're on Facebook. We're on Facebook as ourselves, Stuart Trow, or we're on Facebook as Switch Dumbo, the station that hosts the show. Nobody's pretending that any of this is going to be easy, but it's harder if you don't make use of what help is out there. So I really urge you to sort of engage with the people providing the help, and you know, we feel privileged to be able to sort of highlight these people. So on that note, thank you all very much for listening, and let's talk again very soon. And at this really, really difficult time, please take care out there.